Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cargurus Inc. Annual Report. Cargurus Inc. offers a wide range of services and businesses through its online automotive platform. The company's primary business is operating an online marketplace for buying and selling vehicles, both new and used, in the United States and internationally. The company provides several key services to consumers, including Digital Deal, which allows shoppers to start purchasing from a vehicle details page, VDP, on eligible listings. Finance in Advance, where eligible consumers can pre-qualify for financing on cars from dealerships that offer financing from partners. Sell My Car Top Dealer Offers, which enables dealers to make tailored trade-in offers. And Sell My Car Instant Max Cash Offer, which allows consumers to sell vehicles to dealers online. In addition to these services, the company also provides dealer listings and data insights products, as well as auto manufacturer and advertiser products such as brand reinforcement, category sponsorship, automobile segment exclusivity, and consumer segment exposure. The company's platform also includes Autolist, an online automotive marketplace through mobile applications and a website, and Piston Heads, an automotive marketplace, auction platform, and editorial site for automotive enthusiasts. Overall, Cargurus Inc.'s services and businesses cater to both consumers and dealerships, providing a comprehensive online solution for buying, selling, and trading vehicles. The stock price of Cargurus Inc. has dropped by more than 6.26% over the past year due to several key events and contributing factors. One significant event was the analyst downgrade of its price target from $44 to $37 in February 2026, reflecting a reevaluation of the company's future performance outlook. Additionally, lower margin expectations for 2026 have also contributed to the decline. Company executives announced plans to ramp up investments, which would likely result in a slight step down in margins in pursuit of higher growth rates. This news was met with mixed sentiments from analysts, further impacting the stock price. The company's fourth quarter and full year 2025 earnings report did not provide much relief, as despite exceeding revenue expectations, its GAAP profit fell short of analyst consensus estimates. The broader market environment has also been challenging for Cargurus, with a weakening demand, falling sales, and declining revenue per user over the last 2 years. Furthermore, analysts' forecasts suggest that Cargurus is positioned for weaker revenue growth compared to the broader industry, with an estimated 6.8% annual growth for the next 3 years versus the industry's predicted 16%. The challenging market environment in 2025, including rising car ownership costs and a scarcity of late-model used vehicles, has also impacted the company's stock price. Cargurus Inc. market capitalization of $3 billion is materially smaller than most of its industry peers of roughly $5 billion. Cargurus Inc. trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 7.48 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 34% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for a company can be identified through analysis of various factors. Dealer subscription fees emerge as a consistent theme, contributing significantly to overall revenue growth. Advertising revenue from auto manufacturers and other brand advertisers is another key driver, highlighting the importance of this source in generating revenue. Partnerships with financing services companies also play a crucial role in driving revenue growth. On the other hand, asset impairments and repurchases of common stock are significant contributors to revenue decline. Impairment of assets indicates that the company has experienced losses on its investments or assets, resulting in reduced revenue. Repurchases of common stock can also lead to a decrease in revenue as the company reduces its equity base. Regional trends also provide insight into revenue growth and decline. U.S. revenue is highlighted as a significant contributor to overall revenue growth, while international revenue grows at a slower rate. Understanding these drivers is essential for businesses seeking to optimize their revenue streams and make informed decisions about investments and resource allocation. Net income and profit margins. A turning point in 2023, the company's net income took a hit, decreasing from previous years. However, this trend reversed in 2024 with a remarkable 52% increase, reaching $196.7 million. The upward momentum continued into 2025, with a net income of $155.9 million. The profit margins also underwent significant changes during this period. In 2023, they declined due to reduced revenue growth and increased expenses. However, in 2024, the company's profit margins improved thanks to a 14% increase in revenue and cost savings from the wind-down of CarOffer. By 2025, the profit margin had increased significantly, reaching 17.3%. The reasons behind these improvements are likely due to the company's efforts to cut costs, boost revenue through new initiatives, or enhance operational efficiency. Whatever the strategy, it appears to have paid off, resulting in a substantial increase in net income and profit margins over the past few years. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided data, net cash provided by operating activities increased from $124,527 in 2023 to $255,494 in 2024, and further rose to $295,280 in 2025. This upward trajectory suggests that the company's operations are becoming increasingly profitable. The generation of positive operating cash flow is a significant indicator of a company's financial health. It implies that the business is capable of generating sufficient funds from its core activities to meet its obligations and invest in growth initiatives. Furthermore, the company has demonstrated its ability to fund share repurchases using cash generated from operations, which underscores its financial stability. The consistent generation of positive operating cash flow over 3 years also suggests a high degree of reliability and predictability in the company's financial performance. This is a desirable trait for investors and stakeholders, as it provides confidence in the company's ability to sustain its growth trajectory and deliver value to shareholders. The company's financial situation regarding debt levels and interest expenses has remained relatively stable over the years. However, there have been a few instances where notable changes were observed. On page 82, it was reported that interest expenses decreased significantly from $772,000 in 2024 to $590,000 in 2025. On page 110, an increase in total debt was noted, rising from $32,224 the previous year to $38,393 in 2024. Despite these instances of change, the overall trend suggests that the company's debt levels and interest expenses have not undergone significant alterations. The performance of various segments and regions in the online automotive market has been mixed. In the United States, online automotive marketplaces have performed well, with a notable increase in average monthly unique users by 11%. Online dealerships and e-commerce sites have also seen success, driven by partnerships such as Amazon's collaboration with OEMs. However, peer-to-peer marketplaces like Craigslist.com have struggled. Internationally, the picture is less rosy. International markets have underperformed, with a decline in average monthly unique users of 2%. The UK and Canada have been particularly affected due to established competitors. Additionally, international markets face various challenges and risks that may impact their performance. Revenue growth has also been uneven, with the U.S. experiencing an increase from $647,500 $468 in 2023 to $827,304 in 2025, while international revenue decreased before stabilizing at a lower level. The U.S. market's success can be attributed to its strong talent pool and favorable business environment. However, concerns have been raised about the potential impact of increased visa fees on the availability of skilled workers. In contrast, international markets face significant challenges, including established competitors in key regions like the UK and Canada. Overall, while there are pockets of success, the online automotive market remains a complex and competitive landscape. The management of the company is optimistic about its outlook, expecting revenue growth due to increased user engagement and exposure. The key drivers of this growth include expanding connections with users, measuring average monthly unique users, and increasing dealer subscriptions. To achieve this goal, the company continues to invest in product offerings and new headquarters. In addition to revenue growth, the management is also focused on managing credit risk by maintaining cash reserves and assessing customer creditworthiness. This strategic approach aims to mitigate potential risks and ensure a stable financial position. The company's strategy also involves investing in its products and services, as evident from the $250 million share repurchase program authorized for purchasing Class A common stock. Furthermore, management is aware of external factors such as seasonality and macroeconomic issues that can impact demand for their products and services. Overall, the company's outlook appears to be positive, with a focus on growing revenue through user engagement and product investment, while also managing credit risk and adapting to external market conditions. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company acquired CarOffer's intangible assets and goodwill in a deal that is mentioned on page 104. Additionally, the Acquisition Insights tool was also acquired to help identify potential acquisition targets within market inventory. Furthermore, the company acquired the remaining minority equity interests in CarOffer in 2023. On the other hand, the company has also made some notable divestitures. One of the most significant divestitures was the winding down of CarOffer's operations in the third quarter of 2025. This resulted in total expenditures of $13.3 million and one-time restructuring costs of $5.4 million. The company considered CarOffer abandoned for accounting purposes as of December 31, 2025. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which indicates that the company has distributed a portion of its profits to its investors. This practice demonstrates a focus on rewarding shareholders for their investment in the company. In addition to paying dividends, the company has also engaged in share buybacks. This strategy involves purchasing back shares from existing shareholders, thereby reducing the total number of outstanding shares and potentially increasing the value of each remaining share. By doing so, the company is able to retain a larger portion of its profits and maintain control over its capital structure. Overall, these actions suggest that the company is proactive in managing its finances and prioritizing shareholder value. Concerns about inventory buildup or supply chain disruption are evident in various aspects of the automotive industry. One major concern is the proliferation of direct-to-consumer sales models by manufacturers, which could lead to a decline in dealership numbers and subsequently result in volume compression and revenue loss. Another significant issue is the impact of global supply chain challenges on inventory supply. These challenges include labor disruptions, work stoppages or strikes, economic instability, changes in trade policies, including higher tariff rates and customs duties. Additionally, dealers may pause or cancel listing their inventory in marketplaces due to these challenges. Potential interruptions in data access from third-party providers could also disrupt the supply chain. Furthermore, potential trade policies, tariffs, and renegotiation of existing trade agreements pose a threat to the industry's stability. Natural disasters, public health crises, political crises, negative global climate patterns, or other catastrophic events can also cause disruptions. The financial implications of these concerns are evident in the inventory line fluctuations, with a decrease in 2024 and an increase in 2025. Moreover, the significant difference between inventory value, $338,000, and accounts payable, $4,589,000, may indicate potential concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Cargurus Inc. feel free to comment below, and I will be happy to answer them when possible.